share schemes, I have to talk about these. I kind of have a rule of thumb. If I get 3 questions about something over the year, I put it in. I get 3 questions about this every month, right? A lot of reasons, because there was a lot of media coverage about the fact that Review clamped down on this, and a lot of people who had never dealt with shares or ring their accountants, and accountants either they kind of panic when they get asked about share schemes because they kind of think this is something I should know and I don't know. And the point is, no, it's not something you should know, because every share scheme is different. So the first question is, and I deal with share schemes all the time from both sides, and my first question is still, I need to know the rules of the scheme. That's the first thing, right? People say, oh, it's an approved profit share scheme. I don't care what you think it is. I don't care what they call it. I need to see the rules of the scheme, right? What you'll find is that these tend to fall into 2 or 3 categories. You have the simple tax ones. RSUs are example is that. An RSU is, I'm going to give Lindsay 6 shares, right? But I'm not going to give them to her today because I want to keep her interested and I want to keep her here. So in giving her promises 6 shares today, she get 2 next Christmas, 2 the Christmas after that, and 2 Christmas after that. Now, they're her shares, but they don't get released to her until later on. When they're released to her, the idea, it's basically a cash bonus. That's what it is, performance bonus. If the business improves, so the shares today, we say, I'm going to have 6 shares worth $6 grand, but the business improves, and next year when she gets 2, they're not worth $4 grand, they're worth more. Great, but still a bonus, and she pays tax, right? So there's no trick to be RSUs. Once they're released, you go into your payroll and you pay tax as if they're a bonus. The issue is this: when she gets the 6 shares released to her, the tax is going to be 50%. She's not going to have the 50 grand. So typically what happens is we sell 3 of the shares, get the money to pay the tax. So she ends up with 3 shares, right? Tax paid, 3 shares, everyone's happy. Lindsay then just forgets about those shares and never tells anyone everything ever again. In the meantime, she's getting dividends every year, and then she eventually sells the shares and doesn't tell anyone what capital gains tax. That's the problem, right? Then you have the what we call the profit sharing schemes, various versions, save as you earn scheme, approved profit sharing schemes, a whole lot. They tend to be, you get the shares today, you can't do anything for a couple of years, then you can get them. And if you do that, you're not taxed the income tax. They're the opposite RSUs. They're worth X today, when you get them, they're worth Y, that's capital gains tax, it's not income tax, right? Now, most of the time people sell those shares and off they go, and they have a CGT transaction and everyone's happy. They have a deemed cost and a deemed sale, and that's it. When they don't sell the shares, they still have a transaction, but they also have dividends they have to deal with. And then the third type of schemes are simple share option schemes. The benefit of share option schemes is outlay. The shares are worth 10 grand today, so you have an option to buy one. Right? Now, what you're saying is if they keep going up, and in 3 years' time they're worth 18 grand, you can exercise your option for 10 instead of 17, and you have a gain of 7 grand. That's going to be liable to income tax, not capital gains tax, or capital gains tax, not income tax, depending on the rules of the scheme. But of course, if they don't go up, you just never exercise the option and nothing happens, okay? They're typically the 3 schemes, variances were in them. Get the rules of the scheme, you know what the tax treatment is. Why are we clamping down on these? 2 reasons. Number 1, employers need to be aware of their obligation to capture and report the data. There's a whole raft of share documents out there. They're typically 2 of them matter. If it's an approved profit sharing scheme, you probably don't have to do anything. The trustees are doing it. Everything else, you're probably sticking into an ESA form, right? The one that causes problems, phantom shares. If you don't know what phantom shares are, a lot of the bigger companies run this where you're getting no shares. I basically, Lindsay, you're doing great work, so I'm going to pretend I'm giving you 10 shares today. And if next year, when we check the stock exchange, they're gone up by 20 grand, I'll give you 20 grand. So there's a phantom share. I'm pretending giving her shares, then I'm pretending I'm selling those shares, and I'm giving her a bonus of the difference, right? It's a bonus. It's just cash. It was never anything but cash. But because it's linked to share performance, it's a reportable transaction. That seems to be the single biggest problem with the revenue customers. Otherwise, employers, if they're organized enough to have a share scheme, they tend to get the reporting submissions correct. Right? On the other side of that, employers also should take it on board to make sure their employees know what they're supposed to be doing and not doing. One of the biggest problems you have there are the shares that are held on trust. while they've been vested, be the RSU or profit sharing schemes, and who's reporting them, the whole lot. It doesn't matter as long as someone is, make sure it doesn't fall between two stools. And just remind employees, now that they've got, because the way employees think is, this was all done through payroll, I don't have to do anything. But if you're walking around with 300 grand worth of Apple shares and you're getting 30 grand dividends every year, you kind of need to do something, right? So if you get asked about share schemes, it's not complicated. Find out the rules of the scheme. The tax treatment will be easily discernible. As a matter of fact, 9 times out of 10, they're in the rules of the scheme. What you're really asking is, have you ever told anyone about the dividends you're getting from these? And have you ever told anyone when you sold them? And have you even attempted to do a share history to apply first in, first out? And I'm going to tell you now the answer is no, no, and no. Right? And that's where you come in.